A natural disaster destroys life and property in a finite time and a compressed space, but a human calamity can destroy society for many a generation. On that sobering thought, hello everyone and welcome to a special Zoom edition of Building a Pandemic-Proof Portfolio on the Wizards of Dalal Street. I'm Ramesh Damani. Joining me today is an old India hand, but a veteran who keeps an eye on global fingerprints. With us today, Manish Chokhani, Director, Enam Holdings. Manish, welcome to our show.
Hi, Ramesh. I'm terribly embarrassed that you're interviewing me. It should be the other way around.
I'm sure that's not true. But Manish, investors are confused. We were in a bear market, then the market rallied more than 20%, so we're technically in a bull market. Explain the tea leaves to me. Where are we exactly?
So Ramesh, you know this very lovely quote which Charlie Munger had paraphrased Jack Welch, I'm told, where he said, if you're not confused by what's going on, then you don't really understand what's going on. And that's the kind of world we are in. And I don't think anyone, especially me, should be so bold as to say that I can understand what's going on because this hasn't happened for 100 years. The world has never faced a crisis of this sort. And while we read things and we have heard about the Great Depression of 1929, and I lived through the great crash of 1987 also, where it fell quite vertically. I think what is going on now is so unprecedented because fundamentally, while the factories are all there and the farmlands are all there and the people are all there and nothing has been destroyed, it's been like a war. And you don't know how the fundamentals will turn out on the other side of this war, because all you know is a year from now, maybe we'll have a vaccine, maybe a lot of the world population would have been vaccinated and we'll be back to some kind of normalcy. But what happens in this intervening 12-month period and how balance sheets are demolished of governments, of corporations, and of individuals will determine how we come out and how we start pricing the future, which will then emerge from this inevitably. So in the context of markets, of course, it's normal when a market falls, you get the first big fall, and I've seen even CNBC, put out data which shows that you fall typically by a third, then you bounce up by 20%, then you maybe fall back by a third, and then until you find your feet and the fundamentals kind of make things look apparently cheap, then you can think of starting a new cycle. But it's really a bit too early in this to call this already the bottom of the market or the cycle's over or a new bull market has started. Because knowing what we already know about this pandemic, it's going to come and go in waves, and you will have lockdowns, openings, and therefore you might have an extended kind of WWW kind of pattern for a long extended period until the world realizes that this is now behind us. And it won't be, to my mind, until pretty much spring, summer of 2021. So I would just say a bit more guarded than what people are doing, with a bias to buying things, obviously, because I think the time to sell is kind of behind you now.
But let me play the devil's advocate, Manish. The NASDAQ is less than 3% away from its all-time high. The Dow has rallied more than 20% from the bottom, in effect signaling a new bull market. What has caused those markets to rise and emerging markets to follow somewhat tamely behind them?
So, the same playbook which came out in 2008 after the financial crisis is being played out by the West again. And we jokingly, of course, we've had this chat as well, that every $1 billion is a 1-point rise in the Dow. And I think the central banks of the world have become so complicit in this game of giving you what used to be the Greenspan put, then it became the Bernanke put, and it just continues and continues and continues till today. That by pushing more and more money into the system, the West is playing a game very clearly to stave off their inevitable bankruptcy. The whole world, if we were to look back just briefly, is roughly a $88 or $90 trillion GDP. Global debt is in excess of $260 trillion, which is more than 3 times debt to GDP. There is no way on earth this debt is ever going to get repaid by any of these countries, which is why they're printing and there are no buyers, and it's only their central banks holding on to it. And that money, therefore, does not go into the real world, and it ends up sloshing around in financial markets, where if you again strip down this Dow and NASDAQ phenomena of the last 10 years, of the 20 odd trillion dollars of US market cap, 5 trillion came from real new kind of FANG type companies, which generated tremendous new innovation and created kind of a new metaphor for the world. But a $5 trillion buyback program over the last 5-6 years is what has saved the old economy companies and kept those stock prices afloat. So if you would have taken this out and this punch bowl of free money from the West had not been there, it would have been the most severe bear market of all times. And by repeating this same trick over and over and over again, it's going to be a bit like the pirate plank curve, where when you walk off the ship on a plank blindfolded, you think you're on a proper, surface beneath you because there is wood underneath you, and it's there until it's not there, and you splash down into the sea. And I do think the world and the US, Europe, Japan, all being in theory completely bankrupt, and also morally bankrupt are the rating agencies of the world, who are not calling the emperor naked, who are refusing to remove their sovereign ratings from investment grade, and they keep, in a sense, trying to put down countries like India, who have been generally fiscally responsible, monetary policy has been responsible, and yet we trade at close to one rung above junk bond, whereas Portugal, Italy, Spain, and the others, including Japan, get the benefit of indulgence, if I could call it that, from the rating markets and the bond markets. I think that story is going to change very, very swiftly in the coming 12 months.
Manish, there's an old saying that I'm sure you're familiar with on Wall Street, that you don't fight the Fed. And that means that if in a crisis, they will put liquidity. And that probably explains the sharp pullback that the Dow and NASDAQ have had. Is that what you're saying?
So, if they put in $2 trillion, that's 2,000 points because it's $1 billion a point. In theory, they can put in another couple of $1 trillion and you can have, in theory, a bull market, which will take you past the previous highs, but it's not in real terms, because that currency and those markets will depreciate, and it would depreciate against something else, which is a store of value. It could well be, like people have argued, it might go to gold and cryptocurrencies. They could be kind of the new store of values in the world, or it could be new asset classes such as technology shares or emerging markets, which then take leadership in the world. So I think that regime change and that reset of the world is way past overdue. And it's a bit like, when India depreciates. If you remember the early 1990s, we went from 19 on the rupee to 31. And you could have technically said India is in a bull market because, the rupee plunged, profits went up. Everything looked okay if you were sitting in rupee terms, except you lost purchasing power and the value of gold zoomed. And the rest of the world sneered at us and said, look, we didn't make any returns in dollars. And I think the shoe is exactly on the other foot now, that the time will be there within the next 12 months where someone will call the bluff of all these guys printing money like there's no tomorrow. A genius like Howard Marks has put out that why can't, in theory, if you want to stretch this argument to its logical conclusion, the Fed can just send $1 million to every single American, and it'll be whatever, $350 trillion. US is the reserve currency of the world, and no one can fight the Fed. Every American will be a millionaire, and they can go out and consume, and they can go and buy stocks, and the whole world will be then ruled by America. And because that's theoretically an impossibility, the question is, where does the truth lie? Does it lie at $7 trillion stimulus? Does it lie at 350 trillion of stimulus, or does it lie somewhere in between? And my honest assessment is that already these guys have overstayed their welcome of using their brand power, if I may call it that, where the whole world thinks this is the most powerful economies of the world and there is no alternative, and therefore we keep buying it. But you and I both know, when things get stretched to an extreme, like it happened in the tech bubble or it happened in the consumer sector bubble, leadership dramatically turns and it changes. And you're left holding the can because you don't know what happened when things fall by 66% from there. So I think it's a global reset coming, and we should be prepared for that and not get really fooled by all this funny money which is sloshing around.
I know, Manish, those are called Minsky moments, till things work, till they don't work. And you're saying we perhaps are heading to that position. But let me pull you back to some person, to a country that you said is being fiscally responsible, India. Now, interest rates in the world are at 5,000-year lows. I mean, they haven't been lower since biblical times. Oil is at 2-generation lows. And India's rival for power in the world, China, is no longer the friend of the world. Isn't this a good time then for India? And are the markets reflecting that perhaps?
Yeah, so it's my sense now that the way India plays this game in the next 3 months is going to be critical to deciding whether we emerge as a perpetually emerging market country which keeps talking about purchasing power parity, or we really get into the big boy league and play the game the way these 5 countries which are ahead of us have played. And if you think of it, the rules of the game changed in 2008, and India missed the trick of what was going on in the world. And for the last 12 years, we have suffered the consequences of that. And the trick the world played was briefly as follows. They knew they could not renege on their debt and they had to repay it. The only way out for them was therefore to inflate themselves out of trouble by printing money. And in doing so, what they did is let's repress all the savers of the world, which includes people like India, and keep the currencies pegged to each other as strong as possible. So if you look back over the last 12 years, the euro, the dollar, the yen, the British pound, and even the Chinese yuan, because the Chinese realized what game was afoot, they all pretty much stayed pegged in a narrow band to each other. And their interest rates were pretty much close to 0, 1% or thereabouts, which gave enormous purchasing power to their economies. And because no one else was blinking over here, they effectively repressed the savers in their countries as well as in countries like ours, because we chose the kind of 1960s textbook theory of saying however we calculate real effective exchange rates. We depreciated from 40 to the dollar to 76, which is effectively a 90% devaluation of the rupee. And yet we haven't had any great jump in our export share in the world at a time when the Chinese actually tripled. And you'll recall till the end of 2016, it was actually Germany with the strongest currency in the world, who was the largest exporter in the world. And it only got toppled by China in 2017, again, with a currency which was pegged to the dollar. However, having said that, and why I think this regime changes now, is because, like you rightly said, the G7 are now ganging up against China. There is an emotional outcry against China for what they have done to the world by unleashing this horrific virus. Already the noises that President Trump made and signaled the end of WHO funding, the noises which have come out of France, which have come out of Germany, which have come out of UK, which have actually also been mirrored by the smaller country of Australia, suggests there is a new kind of Cold War, a new World War III in some sense emerging. And in that, if we play our cards right, we become a natural beneficiary of these broken global supply chains to attract a lot of that supply chain here. Number two, if you become the darling and show that there is growth potential in this market, and we have the ability to play the game of strong currency, weak interest rates, to allow, one, our consumers to get little more purchasing power, and B, to allow our industry to get a lot more competitive, and three, if we work with governments to completely ease the ease of doing business in India from this rank of whatever, 50, 60, wherever we are. If we aspire to becoming the top 3, the ranking of ease of doing business has to be top 3. It cannot be languishing at 50 and 60, even though it's progress. And the stability of our laws and our taxation and the way we enforce, all of these have to come together like we did in 1991, where the period of crisis was turned into magnificent opportunity and created a glorious bull market and a glorious economy for India. I think that time is here. And therefore, in some sense, the market is hoping rather than smelling that and still staying a bit optimistic.
Manish, is this what they say about second marriage, the triumph of hope over reality? I mean, do you really think that this crisis will force India to change in so many ways that we will become the supply chain alternative, we will privatize our PSUs, we'll actually do administrative and bureaucratic reforms that will help the Indian economy grow? Do you actually expect all these good things to come out of this crisis?
So the thing with India is we only reform when there is a public outcry, because someone said it very well, that leaders are not really leaders. They are followers in a democracy. And when the pain becomes so high as it is indeed now, and I think it will get a lot more horrific when we realize the mass layoffs which lie ahead of us. Because by not having this rapid response as we should have had already by now, we've had the RBI response, we still haven't had it from the government. But if this response does not come, please remember most companies that you and I talk to are already slashing salaries, are already trying to lay off people, have already gone into capex freeze mode. They're already slimming their fixed costs down. all of which points to a complete depression and deflation in India. And when that pain manifests itself, the response that will be required will have to be completely unorthodox and completely different from what we've tried for the last 12 years, because otherwise that will kind of fulfill the definition of insanity, of doing the same thing which has not been producing results so far. To make the same point, if you recall from 2000 to 2010, which largely benefited from the Vajpayee years, and the NDA won a kind of glorious bull market, which coincided with the world reflating itself, almost all our parameters of consumption and exports showed dramatic improvement. If you think of consumption, and I split it into buying a home for $100,000, buying a car for $10,000, and buying a consumer durable for $1,000, in that decade, almost every consumption item went 3 times to 4 times. And given that our income slope should have been curving upwards, the expectation all of us had at the beginning of this decade was that the great Indian consumption boom is coming, and we will end this decade with almost 4 to 6 times growth in most consumer categories. And indeed, if you look back at the bull market, which happened in this decade, it was in consumer finance, it was in, for instance, in retail, DMart, Amazon, all of the ilk which came in. It was in names like Eicher Motors, Page Industries. It was in retail-facing banks. It was in the financialization and the mutual fund industry emerging. And if we ended the decade with all these stocks looking horribly expensive, because contrary to an expectation of 4 times to 6 times growth, almost without exception, none of these categories have doubled in the last 10 years at best. And therefore, the pain is now so severe that the government balance sheet is in bad shape, corporate India balance sheet and profits are at bad shape, and the Indian consumer debt, which used to be very low, is approaching 20% of GDP. So unless there's a big, big revival of the profit cycle, there is no equity left in India. And everyone from the government to our largest corporations like Reliance are looking to raise equity from overseas. And that will not be the acceptable solution in India. You will have to get this profit share back in a massive way by allowing, like I said, supernormal profits to come with A, keeping rates low and repressing the savers for some time, B, keeping the currency high because you have this $500 billion of reserves sitting there waiting to be used. And it's surprising to me that in this scenario, when oil has fallen, current account is great, why on earth has the Indian rupee depreciated or been allowed to depreciate with a minor outflow of $20 billion? So this is really the policy changes, which I think, and I'm very hopeful, that circumstances and the public will force our society and our governments to make.
You put that in a formula, Manish, in a presentation you gave. You said plus 10, minus 13, referring to the fiscal deficit that India faces. What is your sense that you feel that's untenable, of course, but don't you think at this point we have to also go like the West and play T20 cricket?
Yeah, so I mean that analogy we used of, the world is playing T20 cricket and we are trying to play Test cricket. If you remember the first World Cup when Sunil Gavaskar, thinking it is still Test cricket rules, batted for 60 overs in a one-day match, making 36 runs, I don't know, maybe playing for a draw. And India seems to be playing the economic game in that same way, very much in the old colonial mindset of a commodity producing country, which is thinking cost plus. Whereas the world is playing the economic game from what you would call the classic brand marketing approach, where because their perception is of great military power, their perception is of unlimited financial and technological prowess, they are getting away with selling you their currency and their way of thinking without you responding in an appropriate and effective manner, the way China took on the West in the last 10 years and zoomed past India from being literally the same size as us 20 years ago to now being 6 times our size, was because they understood.
We are running out of time. So let me just get one more question in there because I want your thoughts on that. Given the way the world is working out, you always realize that the investing world has changed, the world has changed, investing world has changed. How would you build a portfolio around this time? What are the sectors that you would favor? What are the sectors that you would avoid?
So very quickly, Ramesh, if you think in every crash, which is what we're going through, you get the innovative companies who think and do things differently, which emerge. And if you think back to the 2008 crisis or even the 2001 crisis, the gigantic corporations which came out in the West and indeed in China were the technological leaders of the world. In India, I would argue that people who did things differently, for example, the Bajaj Finance or your own DMart, who kind of redefined how business is done and how can you expand the markets, or even companies like Titan, for example, completely took the unorganized sector and made it organized. It's those kinds of leadership companies which think branding, margin, and scale are the ones who actually come out very well. And again, it'll come back in the same way to the leaders in India whose balance sheets are in good shape will disproportionately gain in this cycle 1 year out. So I divided it into 4 categories. That number one, all the leaders, whether it is in financial services, whether it is in media, whether it is in even automobiles and consumer durables, with strong cash flows and balance sheets come out very, very ahead in this. Number 2, as global supply chains inevitably have to shift to India, it's already happening with pharmaceuticals, specialty chemicals. I expect it will continue to others, including the whole auto chain, including the engineering chain, and so on. And who can build scale and export. And the most obvious one to pull out was textiles, which also you need to do a lot of things, but I do think a lot of that will happen. So the exporters become category.
Almost out of time. Let me ask you a final question. Will India open, or should India open again for business on May 4th?
So look, the way this virus operates is the minute you open, it goes viral and it will force another shutdown. So you'll have no choice but to do spot opening, spot closing. And this is going to recur, like I said, for the next 12 months. This virus is not going to go to zero. And there is an alternative to keep you locked down for 12 months. So it will have to be stop, start, stop, start, stop, start. And that's how I'm going to see it.
We'll have to stop it right there, Manish. Thank you so much. I'll read a conclusion out for you. While disasters capture headlines and attention in the short run, the work of recovery and rebuilding is, of course, long-term. That's true for mankind. It's true for markets also. Manish, thank you so much for joining us on the Wizards of Dalal Street.